As you heard by now, mortgage interest rates continue to increase steadily every month. How will this affect you buying your first home or getting another home? How will it affect your debt to income ratio and so forth? Will you be priced out of a home because you can afford the mortgage? We'll talk about that in today's video. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, real estate agent and investor, helping you build wealth in real estate. If you're currently thinking about buying or selling real estate, or want to know more about building passive income in real estate, you've come to the right place. Please subscribe to my channel. Don't forget to hit the bell. You'll be notified every time a new video comes out.
All right, let's do this. Are you ready? All right, I'm gonna try to move as fast as I can and try to keep this video to about no more than 12 minutes. So we're gonna start with different model scenarios of your annual income. We're gonna start at 60,000, whether it's you or you and your significant other. We're gonna go 60,000, 70,000, 80,000, all the way up to 100,000 to see how much house you can afford given where interest rates are today. So let's do this. So at $60,000 per year, the average lender's maximum debt to income ratio is 45%. I'm putting that as a 45%, kind of a middle of the road. It could be between 40 and 55% of your income versus debt. So at $60,000 a year, you're making $5,000 a month. To calculate your monthly debt, we just take, this is just a random case, a random person, average person with one car payment, $325 a month, car payment. You say, let's assume you have two credit cards. One, you're paying $70 per month, and the other one, $100 a month. You say you have a small loan, you're paying $150 per month. Your total debt minus the mortgage, that doesn't include the mortgage yet, $645. What is your maximum mortgage payment, principal and interest? In this scenario is $1,605. Let me show you what happens as the income goes up. Okay, so say your income goes up to $70,000. Your maximum mortgage payment becomes $1,980, right? And then what happens at $80,000? Your max payment becomes $2,355, and so on. But let's go all the way to $100,000. You can actually afford a principal and interest payment of $3,105. So, but we'll come back to that in a second. So I want to show you how much house you can afford over on bank rate. Okay. So 1605, keep that number in mind. We're gonna go with $300,000. It's possible to find $300,000 homes. And let's say you really have very little down payment. You say you have 3%, so which means an FHA loan, first time home buyer or FHA loan, and your FICO, your credit score was at least 680 to 699 on a 30-year fixed. There are 3 lenders in bank rate that will be able to give you a loan assuming you qualify. Your interest rate on the note will be 2.99, 2.875, or as high as 3.875. Your APR is the combination of your interest rate plus your points and fees, which makes it higher. This is your effective annual percentage rate. These are the different upfront costs, which are made up of points. A point is 1% of the loan. The higher your credit score, the lesser the points, because you're more of a lesser risk. The lower your FICO score, the higher risk, the more points. So 1225s. So you can actually get a loan for 1207, as little as 1207 principal and interest, all the way up to 1368. Keep in mind that.
Was this video helpful? I hope so. But if you're thinking about buying or selling real estate, I would love to help you. Please connect with me. You can just simply drop me a comment below and I'll get back to you. I think there's some great opportunities coming up in 2022. I would love to help you.
This payment does not include premium mortgage insurance, also known as PMI. PMI would add a note, depending on the loan, anywhere from $150 to $250 a month. It's the insurance that you must have if you don't have 20% down, which in this case we're looking at any 3%. So that, just keep that in mind. So the numbers will go higher. Some lenders will actually require impounding of your taxes and insurance. Your property taxes could be anywhere from 1% to 1.5% of the actual purchase price. Your your homeowner's insurance. Fire insurance could be anywhere from $800 to $1,300, depending on the type of insurance that you get. So those will actually add to that. But lenders really don't care about that. They just want to see how you qualify based on the income. So, okay, so that's that, right? So let's say if you had a little more 5% down, your payment would, in some cases will be lower because you're putting more money down. 15%, $15,000 is 5% on a $300,000 purchase. That does not include your closing costs, which could be anywhere from 0.97, basically 1 to 1.5% of that purchase price. Plus, some lenders will want you to have some savings, some seasoning, or some money on cash on reserves for 6 months worth of mortgage payments. We're not gonna get into that right now. We just want to see how much house we can afford. So we can actually afford, based on this, there's 4 lenders anywhere from $1,174 to $1,300. We can actually go a little higher. So let's go a little higher. I believe that we can go higher than at least $350. A 5% down. You're starting to kind of get to the limit here. So $1,402, $1,370, anywhere from as little as $1,370 per month to $1,500 per month. Actually, it's $1,646. So as we go higher, say we go $360,000 purchase price, we're starting to kind of tap out as our $60,000. So, this lender Quicken Loans, your principal and interest payment would be $1,560, $1,409, $1,692. So you're starting to see that we're starting to kind of get to the upper limit. So how much house you can afford? Probably you're looking at between $350 and $360. But if you wanted to put a little more money down, say you wanted to put 10% down, it's going to lower your payment some, which means that you can actually afford to get a little more house. Let's say what happens at $370. What is our mortgage payment? So you see how the variables change. If your FICO was a little higher and it puts you in the in the 700 range, at least 7, you're going to notice that the higher your credit score, the lower the payment, because you present less of a risk to the lender. So in that case, if you have 10% down and your credit score is at least 700, you can actually afford a little more house. You may be able to go at $380,000. This is great. Even $385. Let's see. Yeah, so this is great. So this is a bank rate is a great tool and it's free. I have an account with them, but you don't have to pay anything. This is just kind of helps you get an idea how much house you can afford. Now, what happens if our income was higher? Say your income was $70,000 per year. Now we go up to $1,980, just shy of $2,000 a month mortgage payment. Now, before I go any farther, I want to tell you this. Now, although lenders may say that your maximum debt to income ratio cannot exceed 45% or 50%, they are only operating under gross income. This does not include your net income. So your net income is usually, your take-home pay will be about 75%, depending on your taxes, your personal taxes, whether you're single or married with dependents or no dependents. Your take-home pay will usually average about 75 cents on the dollar. So your take-home payment is a lot less, which is actually your residual income right here, which you have to live on, right? So you really better be wise, and a lot of financial experts suggest that you should probably be around 35%, not 45%. People like Dave Ramsey, financial coaches, they would say, they would strongly suggest that you want to get as little debt to income ratio as you can. The suggested mortgage payment under that scenario, a 35% debt to income ratio, would be $1,396 versus $1,980. Do you see the difference? Right here is very conservative. Here's a little more aggressive. So you have to make up your mind. You understand your appetite for risk and the kind of mortgage that you're gonna get. At $70,000, $1,980, what can we do here? We can definitely go higher. We may be able to let's just start at $425,000 and see what happens. At $425,000, assuming your credit score is at least 700, you can definitely afford You could definitely afford it at 10% down. But what if you have 5% down? What would our mortgage payment be at 5% down? We kind of get into the 1980. We're starting to see higher mortgage payments. 1911, which put you at the max mortgage payment, 425 with 5% down. But watch this as I change your credit score. What if your credit scores went down a little bit? 1 point from 700 to 699, the average of your 3 major credit bureaus. You will definitely not be able to qualify for Go Mortgage. You may be able to be fine with Loan Monkey. Quicken Loans at 1841, that is still in the threshold. The rates out as of December 18th, 2021, they may change tomorrow. And then, they may change next month. They may go down or they may go higher. Probably my guess is they're going to continue to go higher, probably in the mid threes sometime next year. So if you're going to buy, you probably want to buy sooner than later. Right now, your APR, it's higher than your interest rate. The interest rate on the loan, combined with the points and fees that you would pay, and a point is 1% of the loan, will make your APR go higher. If you have any questions about that, feel free to reach me. I'd love to be able to help you either buying or selling your property. Right now, we're talking about buying. So, all right, so let's go here. What happens if we're making $100,000 a year gross wages? Now you can actually go a 35 debt to income ratio. You can qualify for a $2,200 per month principal and interest payment, or 3105 at 45% debt to income ratio. Okay, so in this case, 3105, let's push it to the limit. How much house can you buy? The highest purchase price you can afford to buy. Make an offer us through a lender, pre-qual letter, 3105. Okay, let's see. So let's go for 550,000. Well, actually, let's go for 600,000. 600,000, 5% down. Say your credit score is good, but not quite 700. So say you are at between 680 and 699 on a 30-year fix. You have 5% down on a purchase. It looks like a 3105 was definitely within range. You can maybe be able to afford to go to 625. At 625, 2,500. So you can go as little as $2,400, $2,500, or $2,899. At $2,899, you're pretty close to your limit here. 2,708. There's a little room. Let's go to 650,000, which is a little more realistic if you live in California, because you won't be able to buy much in LA or the Bay Area, 650, but you can buy a whole lot of house in the Central Valley. And I am in Fresno, so if you're looking at Fresno, please, reach out to me. $3,015 principal and interest payment. You can see here with Go Mortgage, $2,600. This is a 30-year fixed, so not bad. Let's go to 700,000. 700,000. Okay, so after so many searches, the system will just ask you to refresh and wait, because they're in the business of connecting you. They're an aggregator. They're connecting you with other people so that can give you. So we're gonna pause this for now here, and I'm gonna show you this. So this tool, I can make it available for you. You can just play with it. There's a lot of mortgage payment calculators out there. If you want mine, I'd be happy to share with you. But this is really helpful. I mean, all of these variables can change. Say your credit cards were a little higher, so you can actually, say if one of your credit cards was $150 per month, and the other one $100, you had a small loan, and everything, and all the variables actually do change. So hopefully this gives you an idea of what you're working with. If you have any more questions, please reach out to me, and I want to hear some feedback. Just let me know what you think of this video. Thanks.
For a limited time, I'm giving away my house flipping calculator. This Excel workbook, I worked for years perfecting it, help you really know how much profit you're gonna make long before you acquire the property. My gift to you, to download it, just click on the link below. Hope you enjoy it.